Hello, fellow Rebel Capitalists. Hope you're well. Big day today. The PCE data comes out, and I believe it's the delayed data, but I think it's also the updated. Now, what's interesting here is it was supposed to come out at 8:30 this morning Eastern time. It looks like they said that it's actually going to come out at 10 o'clock. It's weird to me that they're cutting it so close. Like it's really like an extra hour and a half. It's like getting your homework done right before the teacher says that it's due instead of doing it the night before. But let's go over to the calendar just so we can see what the expectations are. And it should come out in 9 minutes. So I just wanted to do this live and do kind of like a reaction video, see what's happening to interest rates, and then, of course, see what happens to the odds that the Fed cuts here in, what is it, 4 or 5 days, huh? Let's see. It is 5 days. So currently, let's just get a read before the report comes out. We've got an 87.2% chance the Fed cuts, a 12.8% chance they pause. So we'll see. Let me just actually write that down. So we've got that. Okay. And now let's go. Let's see here. Let's go back over to the calendar. So expectations. You see what I'm saying here? I think the personal income, personal spending, okay, delayed report, the PCE index delayed report, but then we've got PCE year over year, and it looks like that is the most recent data, I would assume. And then we've got core PCE here, the delayed report, and the up-to-date data here on the core PCE. So Josh, are you there, buddy?
Yeah, I'm here.
Okay, so what I want you to do is take it from here. I got to answer the door. I've got
Okay.
these guys, you know how Columbia is. The guys show up late. So let me do a screen share because what I want to talk about next are interest rates. So let's go over to the 10-year Treasury, and I'm going to go to year to date. So let's talk about the trend here. And
I'll talk about the trend while you're gone. Don't worry.
30 seconds.
So I think George is actually going on a Tinder break, and he just needs to make sure he gets his swipes in because that's all he thinks I do. But yeah, so looking at the trend here of the 10-year Treasury, it is definitely going down. What does everyone else think about the 10-year Treasury and the new inflation numbers that are being released right now?
Okay. Oh, what are you going to the chat?
No, I was saying that you had a quick Tinder swiping break to make sure that you could.
Yeah. Okay. Touche, my friend. Touche. All right. Getting back to business. So we've got the 10-year Treasury trading at 4.11. You can see the trend for the year. And full disclosure, I just put on a long bet with the TLT. So the way I did that is I did what they call a vertical put spread. And so I won't go over the details. I shared that for Rebel Capitalist Pro members. If you want to check that out, Josh will put a link in the description below. But so I have a bias here that interest rates will probably go down over the next, let's say, month. Now, what's my confidence level? Is it like 99%? No. And, you know, that's one of the problems when you listen to the mainstream media or you listen to individuals on social media. They always talk about things in terms of black and white. Like everything is binary. You're either, 100% confident that the interest rates will go up, or you're 100% confident that they'll go down. And anyone that disputes that is just a retard. And that's a really, as Jim Rogers says, that's a quick way to the poorhouse. What we want to do as prudent investors is we want to understand that there's just degrees of confidence, there's probabilities, there's no certainties. And then what you do is you determine kind of in your own mind, based on your own analysis, what the probabilities are, and then see if the market is pricing that in. So as an example, my confidence level that the 10-year treasury will be lower in, let's say, a month is maybe 65%, let's just say. So if it's 65%, then I go out there and see what trades I can put on that are attractive. So as an example, with this put spread, they were paying me just 1-to-1. It's like a game of blackjack where you basically bet $5 and either you lose the $5 or you make the $5. And for those of you who know my backstory, you know that I have a lot of experience in blackjack. And in blackjack, I mean, you're just looking for an edge of like, if you can get like a 1 or 2% edge over the house, that's good. And then based on the cards that are in the deck, sometimes that can go up quite a bit higher. And when it goes higher, obviously you want to bet more money. That's how counting cards works. So if you can give me, I don't know what you call it, 1-to-1. So I bet $5 and I either lose the $5 or I make the $5, and you can give me that with 65% or 70% odds, I'm going to take that all day long. I'm going to take that all day long. Now, if I said I have a 65% confidence, and if I bet $5, I either lose the $5 or I only make $1. No, absolutely not. I'm not going to take that bet. So you see, it's and again, this is why social media and the mainstream media and people who just watch these talking heads that are just absolutists, right? Well, gold is going to go up or gold is going to go down or the S&P 500 is going to, well, maybe, but what are the odds? And then what's priced in right now? And the way I heard a podcast one time, and I wish I could remember the person who said this because I'd like to give them credit, but it really resonated with me. They said the way you make money in investing or trading or whatever is when the probabilities don't match up with the expectations. And the spread is where you get an edge. And knowing what the spread is, that's your edge. And so I think that's what we really need to remember as investors. It's like, do you want to feel good about your portfolio or do you want to make money? Because if you want to make money, you got to be agnostic about this stuff, and you have to think about things in terms of probabilities. Okay, that said, let's go over to the 10-year treasury. Right now, let me refresh. We've got 2 minutes to the report coming out, and this is the daily chart. So we got some volatility here in the 10-year. We're kind of trading at 4.114 right now, kind of bounced down to 4.1, then bounce back up. Trying to decide what to do. Let's see what's happening with the 2-year treasury. A little bit of volatility, not too much here. So we'll have to see. And what's interesting? I saw that Bitcoin was down today. So that almost, 2.18%. That kind of tells me that maybe the market's leaning for a hotter than expected number from the PCE. We'll find out in 2 minutes. All right, let's go back to the calendar. So here we go. Expectations for the delayed report are for a 0.3. And let's see here. The delayed report, 0.3. And then core for a 0.2. And then year over year, let's see. So it doesn't look like, okay, so they're not doing the year over year on the delayed. Okay, that makes sense. So it looks like the real time, if I'm reading this right, the expectation is 2.9 on year over year and core at 2.8. And are we not getting the month? Huh. This is a little bit weird here. Okay, definitely a little confusing. So the bottom line here is what we're looking at for year over year as far as expectations, 2.9%. And what we're looking at as far as core, 2.8. That's kind of what we have to focus on here. let's go back to CNBC and hopefully they give us an update. Okay, it is 10 o'clock. Let me refresh. Usually it comes out on Twitter right away. I'm like, let me bear with me here, guys. I'm going to go to Twitter and see. Usually they get a minute or two before CNBC. Okay, latest. I'm just looking at my phone. Oh, here we go. So this looks core PCE year over year 2.8. The expectation is 2.9. Okay. Core month over, and see, this doesn't say whether this is the delayed data. Headline P, it looks like everything's pretty much coming in line with expectations. Headline PC year over year. Yeah, it looks like almost everything based on just this tweet. Yeah, coming in line with expectations. Yep. Yeah. Okay. So now that that has come out, let's see what's happened to. So again, expectations, you can see them right here on the Market Watch calendar. Let's see if we've got any movement in the 10-year Treasury yield. I don't know if this is delayed. I don't think it is. Huh. Yeah. Nothing. Well, that was anticlimactic. Thanks for tuning in. There you go. It did absolutely zero. Let's go over to let's go to the Fed Watch. Do we have any change here? Let's see, data as of 8:50. Okay, so this might, yeah, that's probably delayed. I don't think this is delayed, but maybe it is. It's saying it's as of last updated 10:02. Let's see if anything's happening on the 2-year. Not too much. Let's go over to the TLT because I've got a bet on that, just out of curiosity. Okay, 88.43. Yeah, so the bet's gone against me, but we've got 30 days for this to play out. And so we will see. I'll keep you guys posted on that. So I think in summary, this really means the Fed will, I mean, obviously 87% that they're going to cut. I don't see the Fed diverting or diverging from expectations. The only thing I can think of is there are a couple hawks on the, the governors or whatever you call them. And Jerome Powell, obviously, from a personal standpoint, he wants to go out. He wants history to remember him as the guy, Paul Volcker 2.0, the guy that broke the back of inflation the second time around. So maybe that's in the back of his mind. That's really the only reason that I can think of, other than just giving the middle finger to Trump. But I don't know that. I think Jerome Powell would probably want to do that, but I think he's probably too professional. He's too much of an adult to actually do that. So I don't see why we don't get a rate cut. And then it just goes back to what we've been talking about on this channel, that it's just all about the labor market. And I think the labor market will continue to deteriorate. And that's why I think interest rates will likely have more tailwind than headwind. Let's go over to the calendar and see. Oh, did it just update? Okay, good. And a lot of time, Market Watch, the calendar takes a while for it to update, but it looks like it just did. So we've got consumer sentiment. Ticked up a little bit, but I saw a survey today where it was really, really, really bad. So PCE year over year, I guess it was just slightly below. The delayed report was slightly above on the month over month. So yeah, same thing, right in line with expectations. Okay, next week though, let's see what we've got. Got initial jobless claims. So it'll be interesting to see if that moves, because we could have had an anomaly yesterday with Thanksgiving. I know Zero Hedge was referencing that. So we'll have to see if it starts climbing back up, because what we got yesterday was incredible. I mean, that outside of the cerveza sickness was the lowest number that we had had since like 1969. Just think about how much smaller the population was for that. The labor pool. I mean, it's really crazy. Really almost unprecedented numbers when you compare apples to apples. But there you go, guys. Wanted to go live, get my real-time reaction, and it's basically right in line with expectations. Didn't really move markets. We'll have to see how, if we get interest rate movements or that Fed watch changes throughout the day, but it probably won't change much. And the bottom line is there is an extremely high probability the Fed cuts rates, but it's already priced into the market. There you go. And remember that we always, if you want to make money, you got to be agnostic about this stuff. We can't be part of a religion. Now, if you want to just feel good about your portfolio, then that's different. Then maybe you just stack it up with whatever helps you sleep well at night and whatever makes you feel good, based on the fact that the US has deficits or debt exploding and you hate that, and so do I. But at the end of the day, it just what matters is what the market thinks, not what you think, if your objective is to make money. And so it's all about probabilities, it's all about expectations, and it has very little to do with binary outcomes or talking heads in social media, CNBC. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you on the next video.